Hello, everyone, and welcome to March 2026's episode of Will's Monthly Market Update. I can't believe it's March already. It's only March 6th at the time I'm recording this, and there's already so much that's happened in the month of March. But if you're new to this series, all it is a high-level overview of what's going on in the market, the world, the economy, posted every single month. And so, like I said, this is March's installment. And without further ado, let's dive right into topic number one, which is on everyone's minds. It's the conflict in Iran. I'm only going to talk about the impact on the markets that this conflict has. And right now, the major impact is oil and the price of oil. Before this conflict started last week, oil was hanging around 50 to 60 bucks a barrel. And that's what we've been used to for quite some time. It's been pretty stable. Since the conflict started last week, oil has been on pretty much a nonstop climb, and I checked the price before I hopped on camera here. It's currently at $87, almost $88 a barrel, and again, I'm recording this on the morning of March 6th, so that could change very, very quickly. But what this means is higher fueling costs. Obviously, you're seeing it at the gas stations all over the place. Here in central Iowa, the price of gas has gone up about 30 to 40 cents. Nothing extreme, but definitely enough to make you notice. But the concern here is trickle-down effect. Higher oil equals higher fueling costs. Higher fueling costs means it costs more to transport goods. When it costs more to transport goods, companies have to make up that money somehow, and they're probably just going to raise the cost of said goods, therefore creating inflation for us, the consumer. Now, if this conflict is resolved within the next week, 2 weeks, whatever, it's pretty short term, I don't think the impact will be too crazy. The price of oil will come back down, and it'll just be a little blip in energy prices. But if this conflict drags on into the fall, like some reports are saying, and oil continues to climb or stay at this elevated level, then you definitely could see that trickle-down effect where there's an increase in inflation in specific goods just because it costs more to transport it, etc. Number two, volatility continues. Now, this week has been quite the roller coaster. Some ups, but a lot of downs. The market is not liking this conflict. It is not liking the increase in oil prices. And I would expect volatility to continue as long as this conflict persists. But I also expect volatility to continue for the rest of the year due to the midterm election. Historically, the market has been pretty volatile in midterm election years and tends to not do great. A lot of fits and starts as we progress through the year and polling data comes out, and then usually has an okay finish to the year. Again, that's according to history. Doesn't mean it's going to happen this time, but just a possibility. So I would definitely expect volatility to be here to stay in 2026 unless there was just an immediate end to the conflict in Iran and for some reason the market seemed to shrug off the midterms, which I don't think it will. So expect volatility to continue through the rest of the year. Number three, higher PPI. Now, PPI is a producer price index. It's just another measure of inflation, but it's on the wholesale level. This is what sellers and manufacturers are paying. And usually PPI and CPI, the CPI is like the main inflation gauge that most people pay attention to. Usually they don't diverge for very long. And a lot of times PPI is a leading indicator of what CPI is going to do. So inflation has been steady for the past number of months. We haven't got down to 2%, the Fed's target, but we've been hanging around the mid to lower twos for a long time. But last week, PPI came out at 2.9%, which was hotter than expected. If you take food and energy out of that equation, it actually increases to 3.6. They take those two out because those two are pretty volatile when it comes to prices. So 2.9, 3.6%, whatever you want to use, that was a lot hotter than what analysts were expecting. and it was also a 0.5 increase month over month. So from December to January, it was 0.5%. And PPI could be a leading indicator of where CPI is going. So if this is a new trend for PPI, there's a strong possibility that CPI is going to start following and reversing course upward. And that means inflation is here to stay and possibly getting worse. Now, the first thing I talked about with Iran, that there's another, there's fuel to the fire on the inflation story. So I know this was a pretty bleak episode, but the conflict in Iran is kind of dictating what markets are doing right now. The market's not enjoying it. Expect volatility to continue through the rest of the year with the conflict in Iran and the midterm election. And then we'll keep an eye on PPI and CPI. We'll see if this was just a rogue one-time reading or if this is a new trend and we're heading back upwards on the inflation front. So make sure to stay tuned for April. I'm sure I'll have a whole bunch of other stuff to talk about because it is only March 6th. We will see you guys next time.